Welcome back. Our tax topic of the week is tax info for new parents. So if you have a new child in your home, congratulations. If not, this still may have some information for you. If you do have children, or if you have grandchildren, feel free to send it on to someone else. The most common questions fall into two categories. What tax credits are available and what are the best ways to save for the future for this new child. So the first tax credit that comes to mind, tax benefit, would be the child tax credit. It's available for children up until they turn 17, so $2,000 per year per child. It's available if your income is under about $200,000 if you're single or filing head of household, up to about $400,000 or so if you're filing jointly. When you're up over that range, the credit starts to disappear and ends up at zero a bit over that. So, but if you're under that, $2,000 per kid per year until Congress changes it. The earned income credit if you are a low-income household, so household income under $40,000 to $50,000, as long as you have wages or self-employment profit, this earned income credit could help you out. It increases your refund. Washington has a working families tax credit that uses the same eligibility criteria and can also kick back a little bit of money to help you out. The child care credit is available if you are paying someone to care for your child up until they turn 13. We did a whole video on this, so I will link to that. But in a nutshell, there's a credit available based on the first $3,000 of care expenses. So the credit on that's generally $600. It's not a lot. It's double if you have 2 or more children. Alternatively, you can use the dependent care benefit option at work. It's a pre-tax, much like a flexible spending account, which allows you to set aside $5,000 per household pre-tax. So if you have just one child, that dependent care benefit in particular can be more of a benefit, but definitely talk to your tax pro if you want to know the nitty-gritty of which one is better for your situation. So saving for the future is another aspect that we get questions about a lot. So the first thing to keep in mind, because grandparents often want to give money to your child, the maximum gift that you can give to any particular individual in any particular year is $17,000 for 2023. You can give more. Your grandparents or the parents can give more to the child, but there is a gift tax filing requirement. We've covered that in another video as well. Always happy to chat about it. So where the money goes is always the key question. So it can go into a savings account in the child's name. The banks do require there be a responsible adult on that account, but it can be in the child's name, child's social security number. You can put the money into a Uniform Transfer to Minors Act account, which again would be in the child's name, the child's social security number. In both of these types of accounts, the earnings are taxable to the child. So interest income, or if it's an investment account, the dividends, the capital gains, those things as they are earned, they would go on the child's tax return. If it's a couple of dollars of interest, obviously they don't have a filing requirement. They're not going to pay tax on that. But if you're getting into the situation where they're earning a couple $1,000s worth of interest or dividends or capital gains in their accounts, they may very well need to file a tax return. And in these situations, there's a certain threshold that changes a bit often that is taxed at their tax rate, but the rest is taxed at yours. The other thing to know about using an account like this to save for them is that these funds belong to the child, and they will have unrestricted access to those funds, particularly when they hit 21. So a popular option is the education savings accounts, the 529 accounts. These accounts grow tax deferred or tax free, depending on how the funds are used when they come back out. You retain control of those funds and how they're invested and how they're distributed. And the funds come out tax-free, so nobody pays tax on the earnings if the funds are used for college. Up to $10,000 can be used for K-12 education, although the real benefit of having the money in the 529 is getting that tax-free growth. So you generally wouldn't want to just put the funds in when the child is 2, 3, 4 years old and then turn around and take it out again for kindergarten. So, but that is an option. You can also use up to $10,000 of these funds for student loan payments. So those are options where the funds come out tax-free, the earnings are coming out tax-free. If you don't use the funds for education, there are some opportunities where the funds will be tax deferred. So you didn't pay tax on them over the years while the child was growing up, and then they hit college age and they received a scholarship, so they didn't need these funds, or tax-free grants, or they went to a military academy. Those are instances where the funds can come out. You'll still pay tax on the earnings, but there won't be a penalty for not using them for education. Same with if the funds come out due to death or disability. If you take it out for any other reason, you just take the money out, and none of these exceptions apply, not only will you pay tax on the earnings, but you'll also pay a 10% penalty. So 529 funds also can be transferred to another beneficiary. So child 1 doesn't go to college, but child 2 is on the college track. You can transfer it from one to the other. There's a new provision starting in 2024 that will allow 529 funds that have been there for at least 15 years to transfer to a Roth IRA with a lifetime maximum of $35,000. So that's a nice way to get some money set aside for retirement for a child that didn't go the college route. Funds can also be transferred to an ABLE account, which is for disabled taxpayers. So the most restrictive way to be transferring funds for the benefit of your child is through trusts. And this is an area where you really need a good estate attorney who knows what they're doing, and the input of your tax pro. Everyone needs to be on the same page about what your goals are for these funds. Trusts do pay tax at higher rates than individuals, and there are definitely some decisions to make around tax and around how you want those funds distributed, how long you want them to remain in the trust, how you want them to be invested. There are a lot of factors that you need that attorney for. Did I miss any questions? Is there anything that came to mind, or anything unrelated that you would like to see addressed in a future video? Definitely let me know. I hope you have a wonderful day, and we'll see you again next week.